Okay. Good morning, everybody, and welcome to the 46th or something. I've kind of losing count, really. The CICMQ Zoom calls. We've been holding these since the 26th of March, as you know. And on this particular one, we have got 32 people on this one. And for the person who's got a beeping noise in the background, that would be I'm not sure who it is. That'd be
That's
great.
me. Sorry, I'm stopped now.
Yeah, that would be your reversing camera, I guess.
Yes.
Yeah, thanks very much. If you could
I'll put myself on mute.
that would be helpful, Catherine. Thank you. So yes, anyway, thanks very much everybody for joining. A really interesting topic this. I have seen the deck and it is very, very good. And I'd very much like to thank John Griffiths from Experian, who is joining us today. I'm just letting more people in. And I'll be sharing the screen. As I said, there's a polling session that's going to happen throughout this deck, so it'd be interesting to get your viewpoints and thoughts on that as well. I'm just going to share my screen to bring up the pack, which is that one there. Okay, and I'm going to hand over. Can you see that deck there, everybody?
Yeah.
Okay, cool, good stuff. I'm just going to put myself on there so I can see everybody. Right, okay, so over to you, John. Thanks very much indeed for coming. If you'd like to tell us what you do, where you're from, and etc., etc.
Sure. Well, thanks, Chris. And first of all, thanks for inviting me onto this session. And good morning, everyone. So as Chris said, I'm John Griffiths. So I'm Market Engagement Director for Credit and Risk within Experian's Business Information Services Division. So everything B2B, everything to do with business commercial data, I should say, not consumer. Now, some of you may have listened to my colleague the other week, Grant McDonald, who gave, I think, a session on this same slot on commercial fraud. He and I sit in the same team. So firstly, a little bit about me. I've been at Experian for a long time. Many years. I actually started off, I joined a small consultancy firm called the PH Group, little P, capital H. I don't know if anyone among you have heard of them. It was actually named after a Jimi Hendrix song, and maybe there can be a prize for trying to guess which which one that is.
Triple Haze.
Yeah, okay, yeah. Yeah, so we specialised in analysing client B2B portfolios, primarily at the time to help them understand, their customer base and market, from everything to doing with, growing market share and understanding their strengths and weaknesses within the market, but also assessing their portfolio risk. And we were acquired by Experian in 2007, which gives you an indication of how long I've been around. I think to somewhat, given obviously the financial crisis was about to hit, I think it's fair to say we're quite glad at the time, although we didn't know it, that we were acquired by a large company such as Experian. I suspect that given the audience here, there'll be few of you haven't come across Experian as a business, but just in case you're less familiar, we are of course one of the three main credit reference agencies in the UK. And our bread and butter primary business activity has always been to help lenders and companies understand which consumers and businesses are worth lending to and on what terms. Now, I always find credit risk always becomes a topic of heightened interest during economic downturn events. And we saw this during the last one, the financial crisis, obviously back in 2008. And of course, we're seeing, this year with the pandemic, COVID-19 pandemic is no exception. But, as we all know, even when the sun is shining, keeping on top of credit risk assessment, keeping an eye out for problem debt is still a vital activity. It's just that in times like these, and there's a real chance that some of the well-run businesses that ultimately did deserve to be borrowed to weren't necessarily doing much wrong, are now facing down the barrel of economic hardship, struggling to pay their bills, potentially defaulting on their debts, as well as obviously the usual suspects. So what I hope to do in the course of the next hour or within this hour is just to talk you through, first of all, some of the trends that we've been seeing in the B2B space in terms of our data and where we think things are going, and then how we think companies, particularly with large SME portfolios, can best manage their customer bases as we navigate through the choppy waters ahead. Just a note on questions. If anyone does have anything, feel free to shout out as we go along, or save them to the end. I don't mind. Next slide, please, Chris. I'm assuming everyone can hear me as well. Again, shout out if you can't. So I'll start by recapping the economic headline figures as this pandemic and obviously the resulting lockdown starts to play out. And you'll all be familiar with, the figures clearly. So here we've got GDP figures going all the way back to 1997. And as you can see, come March, April, they literally fell off a cliff. And interestingly, that little blip in the middle of the chart was the financial crisis a decade ago. So it just puts into comparison then and now how sharp this fall has been. Of course, GDP figures did bounce back a little in May, only by 1.8% mind, but it just goes to show how much ground there is to make up. Next slide, please, Chris. So rolling that into the quarterly view, and we of course are officially now in sharp recession, with the effects of the national lockdown having a devastating impact on many businesses, particularly those in particular sectors, as we'll come onto later. In a lot of cases, their incomes and revenues having to fall to zero as they were forced to shut up shop. Next slide. And again, if we look at unemployment, we call this the real unemployment rate, I'm told by our economists, looking at total hours worked. And again, with adjustments, we can see employment tracking very much with the GDP figures, which just again, reiterating the picture of, where the starting point on which we're working from. Next slide, please, Chris. Right, so now I'm going to show a series of graphs comparing the 2020 line with the like-for-like 2019 figure. So the x-axis along the bottom is the week of the year, starting with obviously one being New Year, to 28 is literally right up to a week or so ago. And obviously I'm only showing the first half of the graph at the moment, which shows that failure events for limited companies over the first 3 months of 2020 closely tracked the same period last year. The grey area, of course, represents the period after lockdown measures were imposed. And as was alluded to, you might sense some form of audience participation coming up, which is correct. So hopefully the technology will work for this. I'm looking to you, Chris. What I'd like you all to do, and we're going to do a poll, is to tell me what you think happens in terms of the graph going forward, so the bit in grey. And in other words, how do you think the 2020 line, in the bit that you can't see, is going to track relative to the 2019, either up, down, roughly the same, or something completely different? So I'll just give you a moment.
You ready to go on the poll? Okay, you should now see the poll. Can everybody see the poll? Yeah, okay.
Cool, so we're only doing number 1 at the moment. Can we do just number 1, Chris, or?
Well, no. If you'd said 2 polls, then I would have put 2 polls in. You just said question 1 and question 2.
Ah, right, okay. Well, we'll see. We'll see. You can guess. You can guess what the question is for 2, and then we can rerun maybe afterwards. Maybe.
I want to make a note of the scores anyway. Okay. Okay.
Just while we're waiting for that, there's a question on the chat I can see. So with the GDP drop, when do you expect the bounce? That's the multi-million-pound question, of course. So our economics team, our in-house economics team, which has fed into some of the data that we see here, they're very much, their base scenario, I think, is based on what we call a delayed V-shape. So it is a sharp decline followed by, you know, a reasonably sharp bound back. But we do expect there to be, you know, that the bounce back to be more prolonged than the drop.
Okay.
And
We're
I
up
think
to 74% of the people have voted now.
cool. Great. Should we?
24. Okay. Shall we stop the poll there? We've got 25 out of 31. So we've got 80% voted. Okay. Let's end the poll there then. Okay, and share the results. Okay, so question 1, what happens to it? We've got 18% upwards. We've got 64% downwards. We've got 16% tracks roughly the same. And we've got 4% does something completely different. That's the Monty Python question. And then and on the second question there, stays roughly the same as week 18, that's 40%. Then we've got 36%, drops even further. And we've got 12%, new territory, 12%, and then 0% shoots up by 1,000%. Okay, that's interesting. Right, so that's okay. So back to you there, John.
Yeah, so that's really interesting. I've just taken a photo just so I can see what the second question. To be fair, we haven't got the context for that one yet, but it'd be interesting just to revisit that when we get to that stage. Chris, if you move on to the next slide just to reveal the result, I think most people got this. This was aligned with what most people put. I think about 60% at least.
64%, yeah.
Yeah. And yeah, what we have found is the number of failure events have reduced significantly, and there's a number of reasons for this. In fact, does anyone know what those reasons are? Perhaps give me a chat with some answers if you do.
Or anybody just come off mute and let us know.
Or, yeah.
Was it the fact of the courts were delaying or putting a hold on enforcements, particularly stack demands, bailiffs, etc., etc.?
Yeah. So there's a couple of reasons. That's one of them. Definitely. So there were some measures put in place to essentially so that companies that may have been wound up didn't. I think what we're also seeing is the effect of some of the government schemes being brought into place as well, and as I'll sort of keep coming back to as we progress, very much in some ways, and this is kind of the aim of the schemes to some extent as well, is to sort of kick the can down the road, so to speak, and not create. They were keen that they didn't want all these business failures in particular. Obviously, layoffs from an employment perspective to happen at the height of lockdown, and we'll see going forward. I said kick the can down the road as opposed to eliminating the risk of that. But I think the two of those together have as you say, caused a sharp decline in those. So I guess the warning is, yes, we've seen failures drop somewhat slightly artificially. And it'll be interesting to see what that line begins to do as we progress through the year. Next slide, please, Chris. So this now is looking at new incorporations, which you know is new limited companies being registered at Companies House, and you know, again comparing since the start of the year. And I suppose the first thing we see is that you know, no one likes to start a company in New Year. Aside from that, the two cohorts again track remarkably up until the point of lockdown, which is the grey area. After which point they diverge. And initially, as we entered lockdown, incorporations did take a dip, but throughout May, they steadily increased to the point where, as we've gone into June and beyond, they're actually now above 2019 levels. And there could be a number of reasons for this, but you know, it is encouraging to see that entrepreneurs are you know, are still out there. Next slide.
Yeah, that's a quick. There's a couple of points on that one. Is it because people are more concerned about their roles? They're starting a new venture. That's one.
Yeah.
We had a chat about this, about business bounce back loans and organisations creating limited companies in order to get business back down business loans. I mean, would that be correct or not correct, or?
Yeah, I mean, the interesting thing about the bounce back loans is you know, the low barrier to entry. And I think to some extent, you know, when you contrast the B-bills with the C-bills, which of course came first, I think there was a bit of probably a rush to get those out. And, you know, the banks weren't really set up to be able to deliver them, you know, quickly. And, you know, take up was quite low. Whereas B-bills, you know, to some extent, you know, when you think about it, low barrier to entry, government, you know, pretty much underwriting everything and taking on all the risk, no payments required or interest paid for the first year. And as we'll see, that is going to have implications. And to be honest, the biggest thing, self-certification. So, you know, if you look at the criteria, quite easy to get 50 grand by saying you were adversely impacted by COVID, and you know, there's a feeling that a lot of these loans probably will never be paid back, and certainly, you know, they were also, you know, they've been used for a number of reasons. Some probably for the original reasons they were intended, but quite often as a way of just consolidating debt. And we've also heard some evidence that some businesses have been able to have more than one bounce back loan with multiple providers as well. So, you know, it is an interesting one. I think I did say as well, I was just probably talking to colleagues in one of the first weeks when we were getting used to lockdown and work from home, and just sort of saying, you know, there's a lot of people who potentially, and a lot of clever people potentially in a situation with not much to do. And you could start to think that, you know, like during periods of, you know, war and other sort of extraordinary events, how, you know, innovation might, you know, great minds might come up with new ideas, and it could actually advance the economy along. So probably some of that as well.
Okay. Sorry. Next slide you asked for.
Yeah. I'm conscious of time. If I get through. So let's just compare now the latest days beyond terms, and this utilises our payment performance data. So what Experian does, it takes payment ledger data from hundreds of contributors as part of what we call our payment performance program, and this helps us to assess how well businesses are, you know, paying their bills, and in particular the trends in trade credit payments, basically. Which tends to, you know, track very well the cash flow health of a business, and can also be seen as an early sign of distress. So if we, you know, compare the latest data from this month, so July 2020, against comparable data from the same time last year, you know, we can see that of the companies that are paying their trade credit terms late, and you know, which by the way is a common occurrence, it's not in itself necessarily a sign of distress. I always point to something like Wetherspoons, where they always pay routinely 80 days beyond due, for example. as a way, and partly because they can. But it's generally the increase or the difference in payment days beyond terms that can have an impact. And as you can see, from last year to this year, the average of those paying late has increased from 16.5 days roughly to over 25, which is a difference of nearly 10 or 56%. And the chart there just sort of highlights that in terms of the sectors where we're seeing the biggest increases. Interestingly, coal mines are atop the list, and there aren't many of those anymore. But of course, we're not burning as much coal at the moment. In fact, I think we've gone for the largest period of time without the requirement to burn coal, and obviously energy usage and so on has plummeted. But it's interesting to see the sectors that that come out on top. Next slide, Chris, please. And despite businesses not failing, we have seen an increase in the first-time arrears on accounts. So that's businesses, missing their payments for the first time. So again, there's the 2020 against the comparable 2019. Notable accounts that saw these increases, including credit and charge cards, hire purchase leasing, telecommunications as well. And so I've just seen there's loads of things in the chat. So yeah, preparing second business, initial one can't be delayed. Yeah, to the incorporations, companies being set up to transfer good assets to protect themselves. Yeah. So question, with the increase in frauds and scams set up during lockdown, has the figure subsided in June? Which one was that? Which question was that relating to? Was that to this slide, or was that?
That question was really about the new setups and the new businesses. In your slide, right. In your slide, we're saying that business setups are going to be increasing.
Yeah.
What proportion of that are fraudulent or fraudulent activities?
Yeah. Well, it's a good question. Yeah, it's a good question, and yeah, certainly one I can take away. Next slide, please, Chris. So the number of commercial searches is still down when compared to last year. So when I mean searches, I mean businesses companies calling the Experian Commercial Bureau for credit checks. This suggests that either applications aren't being made at the same rate, or at least aren't they're not getting as far as the credit bureau being called. But this level has increased more recently compared with the initial decline at the beginning of the lockdown period. And if we go into the next slide, which shows the non-limited businesses, again, the relative lines are broadly the same as the previous graph. We've seen a considerable uptick in non-limited searches over the last month or two. We're not entirely sure what is driving this, but it does suggest that non-limited businesses may be searching for credit more than usual due to the ongoing crisis. Next slide, please, Chris. Okay, so this chart shows the volume of new credit agreements over this year to date compared with last year. It's taken from our current account information sharing, or KEYS program, which all the major lenders contribute to, and is therefore representative of the market. And guess what? Same old story. It's a tale of two halves, pre-lockdown and post-lockdown. You can see the massive impact that the lockdown had in terms of new credit agreements. Now, as you see, this chart only goes up to the start of May, so week 18. And this is actually what the other question was referring to. So, Chris, actually, I don't know if we can bring it up again with the context, or whether actually we just go with it.
Let's see if I can bring it up
as we've got it.
Let me share the.
It might be interesting just to see if we can run it again. Oh, here we go. Yeah,
that's the results that people said. So what they believed at the time.
So it'd be interesting to know if people stand by this now that they know what the context of the question is. So ultimately the question being, and the answers to say is, what happens in week 19? Does it stay roughly the same as it is? And 40% here said yes. Does it drop even further? Yeah, quite a few. Does it move back into, not many people thought it was going to move into positive territory of any flavour. No one thought it was going to shoot up by 1,000%. Does anyone, by the way, have a burning desire to change their mind on that question, given now they've seen this chart? Or are we happy with the answers we've got?
Let's yeah, stick with that, I think. Okay, I'll stop sharing. I'll go back to the deck again.
Cool.
Okay.
This is quite interesting then. So if we go to the next slide, there we are. So it shoots up roughly 1,000% on the week of the 4th of May, which actually 0% of people responded with. And you know, ultimately, this of course coincided with the bounce back loans being introduced. And as I kind of said before, unlike the sort of slightly lukewarm initial reaction to the Seabills loans, you know, the Beebles, I mean, the terms are so favourable that everyone was jumping on board to snap these up like.
Just goes to show what a knowledgeable bunch of credit professionals we have, that we weren't able to predict any of this at all. Yes.
So and literally all we've done is that bit up to week 18, we've just sort of squashed the scale, so you can see how how significant that increase is compared to the you know, the period before.
So that's previous.
Yeah.
And that's what it is. So that score is squashed. Right?
Yes.
Make it look like that, right? Yeah, I get what you mean there. Yeah, wow, that's very significant.
Yes.
Yeah. Okay.
So if we move on to the next slide, Chris, let's just compare a little bit of the profiles of the Beebles loan population versus the general unsecured loan population. Now, what I mean by this, and there's a couple of caveats here. Currently, we can only estimate which loans are Beebles loans in our keys data based on some assumptions we've had to make. Now we are looking, we're working with the lenders to get a definitive flag added for Beebles. In other words, for them to identify to us which ones are Beebles loans, etc. But this is not yet in place, and therefore, you know, we've based this on an estimate as best we can. And again, what we've done is we've looked at obviously the Beebles loan population with a comparable non-Beebles unsecured loan agreement from a period last year. And just to be clear in terms of the comparisons, what this is basically showing is the two populations independently profiled against each other. So if we look at the top graph, which is quite sort of uninteresting because it splits the limited, non-limited. What we're saying is that, you know, most of the Beebles population, or the companies that have taken Beebles loans, have roughly the same split of limited, non-limited as the non-Beebles population. You can't infer anything about how many or limiteds have taken Beebles versus non, and so on. But what's more interesting, if we look at the bottom, is that, sorry, Chris.
Sorry.
No worries. The bottom chart there, which is previous credit agreements, and you can see there's quite a big disparity between the Beebles population, where for a much higher proportion of that cohort, it's their first credit agreement. Whereas, you know, compared to that non-Beebles cohort, so much more likely to be the first time they've borrowed money for Beebles. If we then just flip to the next slide, we've got a breakdown in terms of industry sector. And again, same sort of rules apply. We're comparing the two populations. We've ordered it in terms of the high level sectors that are highest for Beebles. And again, construction and wholesale and retail are coming out at the top in terms of the proportion of firms. But if we, Chris, if we just go on to the next slide, it just highlights, it's the same chart, we highlight in particular some of those sectors.
Hi Nigel, can you hear me? Wait a minute.
Okay. Okay. I think carry on. I think if you're not talking, guys, if you could put yourselves on mute, that would be great. Thanks. Okay, go ahead, John.
No worries. Yeah. So this is just highlighting now which of those where, in particular, the Beebles has a greater proportion of Beebles within that sector. So the profile is more heavily weighted towards those sectors. And again, construction, automotive, food, service industries. Some of the real estate, again, some of the things that were potentially massively impacted by the COVID measures. Next slide, and I need to sort of just rattle through some of these now. Again, finally on this with the new unsecured loans, just splitting it by our commercial Delphi, and this is our, as a measure of the risk of a company. It's our risk score. If you, again, one more slide, Chris, and just highlighting, interestingly, the profile of the Beebles population is very much where the pink bars are much higher than the blue bars, very much weighted towards the riskier end of the spectrum. So that's our max risk, our high risk, above average risk. It goes down to the least risky at the bottom. And again, we've got a greater proportion of Beebles loans being taken by those we're ranking as higher risk businesses, which of course bodes well for the future. Next slide.
My personal favourite slide out of the whole pack, by the way.
It is a good one. So ultimately, this is a sort of bird's eye view of what has been happening so far this year, and also looking with a horizon into next summer. And where does it leave us? Well, obviously, starting off with the start of lockdown, we've summarised the various events that would have had economic impact on companies in the period. All the schemes, the support schemes coming in, which has been great. And as I said, these things have sought to really ease the pressure off businesses and to some extent kick the problem down the road. What is clear is that there's been that there are going to be some there are going to be some stress points ahead as we start to wind down those schemes, and starting very soon, in fact, as obviously the furlough scheme starts to wind down and employment contributions start up. We've already seen a number of high profile rounds of redundancies being announced, and we expect that to continue. Also, the risk of things like further national lockdowns and potentially local lockdowns impacting businesses. Is anyone here from Leicester, by the way, just out of interest? Probably not, but I know since a number of our colleagues, Experian has a big presence in Nottingham, so a number of my colleagues live in the Leicester area and have been sort of caught out, if you like, by that. Next, sorry, actually, yeah, one other point just on that. So it's end of furlough, but also, as I mentioned before, the Beebles loan, as I said, we've got a really successful take up of that. And, it's interest free. The government, in fact, is paying the interest on the first year, and there's no repayments required. So really it's free money for now. But come next May onwards, we're going to start to see interest payments required, and we're going to start to see those loans have to be paid back, and it's at that point again that we're going to be a point of inflection where it might push certainly some companies over the edge. Next slide, please, Chris. Any eagle-eyed among you who did attend Grant's talk a few weeks ago may recognise this slide. I've put it in and I won't go through it in too much detail. But one of the interesting and almost unique things about this economic crisis has been the fact that, you know, the industry in which a business sits has been an absolutely key, crucial part to the potential fate of that business. And we've done some work to broadly group them up into 4 segments here. The greens on the left are essential businesses, your supermarkets, all those supply chains that were, you know, essential to almost run the economy whilst we were at the height of lockdown. And of course, many of which would have seen business revenues and requirements demand increase. And those adaptive businesses in amber there, where, you know, we're talking about those companies, Netflix, for example, is a good example, but those where, you know, their service model was already one of generally remote servicing, online, etc. And of course, some businesses that were able to quickly adapt parts of their business to remove the physical proximity aspect of it. And then of course those in red, which on the right there, particularly the non-essential, which covers all our travel and hospitality industry, and the other businesses where they were again hit maybe indirectly by a lot of the measures, have had the most impact. So you could have been the most sound, well-run restaurant in London, for example, there ever was, but you know, you couldn't do much about the fact that you had to close down for several months. And now you're in a situation where you can only invite back a third or half of your customers. And, you know, many of whom don't want to, you know, venture out anyway. And also faced with the fact that some, you know, life habits may have changed, you know, for good. People have discovered online shopping, for example. And just one last point around the figures at the bottom there, which just goes to show what proportion of the UK economy in terms of companies and, you know, employees sits within those, you know, most impacted sectors, is quite stark. So next slide, please, Chris. So Experian, we've heavily utilised the short and long-term industry sector outlook, taking into account our macroeconomic data, to you know, alongside other data variables like the commercial current account turnover data, which comes from CCDS and our Keys program I've mentioned before. And ultimately, these things we've built something we've called the Business Volatility Index, and again, it's a measure of, you know, how well a specific business is doing both within its sector, but also how that sector is doing within the, you know, the economy as a whole. And really the idea is that, you know, it takes into account the volatile economic market factors that a business, as I mentioned, you've got 2 axes at play. One is, you know, the market that the sector or industry that business sits in and how it has been affected by the external events. And the other thing being the core traditional, you know, ultimately resilience of the business through its management and you know, how financially strong it was. And those 2 factors together are going to be important in terms of determining which businesses are going to be, you know, struggling, which ones are going to need the most help going forward. And as I said previously, we've also got a situation because of these some of these schemes where almost they've sought to prolong the life of companies that perhaps shouldn't be around anyway, that should have failed but haven't because they've been able to be put on life support. And again, we expect to see those types of businesses to potentially come amok as those schemes wind down.
Okay, we've got 15 minutes left, John, just as a time check.
Yeah. No, I'm conscious of that. Yeah. Next slide, please. So in our view, a surge in bad debt is building. And as I said before, when government bailout measures wind down and the recovery remains protracted, such that as well as the typical cases one might see, these external events are going to push many more companies into those you know, problem buckets. And inevitably, you know, obviously I've already mentioned the Beebles loans with their low barriers to entry and generous terms and self-certification. You know, as I just mentioned, a lot of these businesses potentially going to be propped up by these schemes when otherwise they probably would have failed anyway. And of course, pre-COVID-19 collections and recoveries processes are unlikely to meet this increased demand. So we very much believe, and obviously I would say this because Experian primarily is a data company, but we very much think that data has a pivotal role in optimizing the application of resource to, you know, maximize the returns, and believe that active customer management, proactive customer management is absolutely vital to get through this period. So segmentation will enable identification of self-cure cases, the ones you just want to leave alone, those that can't pay, going from, you know, the early signs of distress and delinquency through to, you know, those where potentially they are starting to struggle to pay. Are there things that can be done? Can you reduce exposure and minimize the, you know, the potential loss if it gets to that? And of course, then differentiating the won't pays, those that, you know, some may be fraudulent, or those that simply won't pay no matter what. I mean, you know, at the end of the day, if somebody always pays 15 days late without fail, to some extent, there's an argument to say, don't bother chasing them for the first 15 days, but come down hard on them on the 16th day if they don't pay, because that might be something might be a sign that something is up. So matching accounts to appropriate treatment paths, as I said, actively managing the customer. And we believe that external data, in addition to obviously the internal customer data, can drive that segmentation, and which ultimately is around obviously predicting those that are going to go into delinquency, tracing lost businesses, and ultimately the collection stage. Next slide, please, Chris. So I'm not going to dwell on this, but ultimately, you know, the full end-to-end path is there really. The first stage being early spots. So, you know, what are the signs, and I'll touch upon these in a minute, that actually are the early signs of delinquency, and what data can help predict that. So being active in understanding which customers are likely to fail and when they're likely to fail, so that you can segment and prioritize those. The SCV box on the second left there, data management is key as well, because, you know, it might be that, you know, unless you've got a holistic view of the customer, and you understand all of their, you know, debts and the whole affordability across the piece, you may only have half the picture, and maybe working not off the you know, the right data, and therefore getting a false outcome that everything is okay, through to obviously tracing and engaging with the customer. Actually, just simple things like having the right contact detail and knowing who needs to be contacted. Next slide, please. So yeah, I mean, examples of this, and I'm not going to dwell too much on this, but what sorts of questions do we want to ask as part of the process? You know, identifying, for example, those easy things like those that have high value or high exposure, and, you know, potentially reducing them if we see any early warning signs, flagging early in the, you know, problem cases to put in preventative measures, and also just, you know, again, prioritizing which ones can be left alone versus which ones you might be able to do something about before they become a problem. So next slide, Chris. So, you know, to show data is key. There really are two different views of the customer. And I think, you know, obviously it's very crucial, the internal view, because that gives you, you know, ultimately that's your view of the customer in terms of, you know, how long they've been with you, you know, things like, you know, their KYC status and so on, but also what products, how they spend, how historically have they paid you, and so on is very key. And of course, if, you know, for banks, where they might have the internal current account data, for example, and they can again see things like credit and debit turnover. But of course, that's only part of the view. And although all this stuff is powerful in its own right, it's really when it's enhanced with that external data that it gives you that full 360-degree view. So for example, by external data, we mean, you know, attributes on the company itself, like that you can gather through the likes of public data sources like Companies House, and information that credit reference agencies, obviously like ourselves, hold on them, such as, you know, the lending products they're using, the CCDS data. So again, looking at the current account data from all of the banks, you know, so that ultimately you've got the full view. Many companies have multiple accounts and so on, and understanding the risk across the piece. Next slide, please, Chris. Nearly there now. And I've just, yeah, I just mentioned this is around the linking. It's just important to note, of course, that although we're talking about the entity, it's important to know the context, not just, you know, is it part of a bigger group? Is there a parent that might bail it out? Who are the people behind the business? Is it small enough that those, you know, that the, you know, ultimately those directors, as consumers, you want to understand their behaviours. And in fact, you know, the likes of commercial credit scoring like Delphi that I mentioned, but also others from other credit risk reference agencies already take into account consumer data for companies that have 3 or fewer directors. So the people behind their track record and their behaviours is quite key, especially to small and to young companies, you know, understanding the behaviour of those businesses. Next slide, please, Chris. So look, I've mentioned a lot of data items already, and you know, this slide sort of summarises the relevant ones. I appreciate there's a lot to take in here. You know, we do think one of the most exciting regulatory developments over the past few years has been the mandating of the banks to have to share their current account turnover data. And this, you know, this was designed to level the playing field in the lending space. And, you know, this has really enabled an understanding of the credit and debit turnovers, as I've mentioned before, on SMEs. And you ultimately you get a monthly snapshot basis. So when you know, coupled with debt information like, you know, outstanding balances and the payment performance data, which we mentioned, how well are they, you know, paying to terms? It really is a powerful and timely measure of how a business is doing. And the good thing about these elements is, you know, we're not waiting for, you know, company accounts being filed with Companies House. And we all know that, you know, there are so many exceptions to filing requirements that in a lot of cases, that data is missing and incomplete. And yet this information gives you, you know, ultimately, and has proved valuable through this crisis, an up-to-date view on, you know, the current cash position of these businesses. And there's a whole lot of other things I mentioned, the sector data and the scores and so on already. Next slide.
5 minutes there.
Yeah, I'm wrapping up. So very quickly, just a couple of examples of how you might use that data. So again, you know, it's all about proactive customer management. So, you know, here's an example of a business that's performing well. You know, we can see its credit turnover is above its debit turnover and diverging. It's increasing with time. And in fact, we might want to use this information armed with some of the other stuff we mentioned to you know, potentially offer them more credit, increase their limit, be proactive in terms of renewals or offering them, you know, other products that might suit their plans. But of course, we can then monitor that over time and see how these metrics change, such as, you know, if they do take on new debt and these metrics change, then we can respond to them. And next slide, please. So here's obviously when those indicators do start to change direction, then they can provide, you know, an early warning signs again that might trigger proactive actions that seek to support the business, or at least minimise the exposure, potential loss to that business. Next slide, please, Chris. We're almost there. So we're almost at the end. I thought it was just worth mentioning before we do end a couple of additional thoughts. And again, I haven't really mentioned, obviously a data-driven approach, as I say, can yield, good results. But without trying to pun on this, being open to new data, particularly the things like open banking and management accounts and other data sources, there is so much out there that we're still trying to get to grips of in terms of how we can use this data. And obviously these are consented data sources. There's a lot of controls around these, but understanding and giving the business the right, value payoff in exchange for sharing their own data, by allowing them to offer better terms or something to help them. There's so much opportunity to do that and to help minimize the risk. And final slide, and just really a few other considerations. I think it's worth not forgetting that these are unprecedented times, and there's been a lot for lenders to adapt to in a short space of time. For example, many businesses may not have reviewed their models recently. Their accuracy may have degraded. They may not be exploiting the full breadth of data that is now available, particularly those, some of those aforementioned data items that are extremely responsive to those changes as they happen, rather than waiting for lagged data. So to summarise, the last few months have seen rapid change in trading conditions, unlike anything seen before. And I think the key thing is, as the support schemes start to wind down, the hardship is really going to start to bite. And so using data insight to proactively manage the portfolio is more crucial than ever. Thank you.
Okay, thanks very much indeed, John.
Appreciate we're bang on up to time.
Yeah, we are. I mean, I've just shut that down. There's a couple. We'll do some questions in a minute. And before everybody disappears, I just wanted to say to D Weston, congratulations! You're the 1,000th delegate on our CICMQ calls. So and you get. I will put you. I just want to put you onto speaker view. So if you'd like to say something, Dee, and I want to take a screenshot.
Thank you very much. That's really lovely, because I have really enjoyed participating. Thank you.
Okay, that's great. So congratulations. I'll get in touch with you afterwards, and we'll sort out the prize. I need to get you. You're going to get an Amazon Echo Dot, which will be sent to you.
Thank you.
Very well. I just wanted to make sure I got that in before everybody left. Thank you, John. That was unbelievably insightful, and a little scary as well, I have to say. A bit like the presentation that we had from Grant about fraud and stuff. Very scary. Lots and lots of data and facts in there. We will be posting that pack. What I'm probably going to do is see if I can get it put onto the CICMQ articles page of the CICMQ page. It is a hefty pack, so emailing it out, as we found this morning, John, is a little bit difficult, because it was 15 or something megabytes, and that was when it was zipped. So what I'll do is I'll get it put onto the CICM page, and I'll send everybody a link to it as well, so that they can get access to it. While we're all here, has anybody got any questions that they would like to ask John while we're on? Any questions? We've had a number of points coming up about if customers are requesting payment terms extensions, etc. Charles mentioned things like directors' guarantees and stuff like that, to make sure that they're serious, that they're going to pay it back. Anybody got any other questions?
It's not a question so much, Chris. It's just an observation. I think the valid point of when all the benefits end from the government, the impact have on the partners. We're all seeing that they clearly don't have a cash pot to kind of see them through the difficult periods. So they're leaning on other resources. And as I noted earlier on to you guys, that we ourselves are seeing negotiations for partners coming through. They're not necessarily all picking up on the government schemes, but those that have actually told us they have, and they've actually taken advantage of the free interest loans.
Yeah, I mean, this slide here, the one that we showed earlier, the one about the timeline, is a real cracking one.
Yeah.
As I said, I'm going to steal it. But the interesting thing was that when we had our calls a while ago, the CICMQ community generally, they were saying that, and we were in sort of like March, April, sort of May time at the time, we said, when do we really think it's going to start to hit? And people have said, well, you know, it's probably going to start to hit most of all in sort of early 2021.
Yes.
And if you look at it here, this is when, you know, end of furlough and all of this stuff starts to end. And Alan actually mentioned, Alan Brown mentioned that the insolvency practitioners are anticipating January 2021 as being the time when things hit. So there's kind of this consensus that it's all going to get hideously awful in January 2021. So that's, you know, and I think that what you said today, John, it kind of backs that up as well. We're going to see a trickle of this stuff coming through as various things end, and then it's going to really ramp up towards the end of the end of the year and then through into January and onwards, I think.
Yeah, and Chris, one other thing, as an area, I think we'll see more smokescreen disputes, especially as payments are requested. Because I think, you know, especially in the retail industry, the easiest way to delay payment is I've got a dispute, and if it's a partial dispute, there is a tendency of holding off the full invoice until the dispute. So I see an increase in disputes, and you know, companies would need to keep an eye on dispute management.
Yeah, and I think that's, I mean, you made that point, didn't you, John, about can't pay, won't pay, can pay, can't pay, in the note there. And we put together, in Kinetic, we put together a chart just to that, so that if you've got a matrix, you've got customers in the can pay, can't pay, won't pay, can't pay sort of quadrants. What we've done is we've tried to sort of give a series of steps that you can take depending on what type of customer that is and how you've identified them as being in one of those particular boxes. And this is something we put together, as I said, for an international clients last year, and it's proved very useful, and people have been quite popular wanting to get hold of that. So that's it. Has anybody else got anything they want to add before I finish the recording, or any questions? Okay, I'll finish the recording now. So thank you very much indeed, John, for the insight and the input. We will be putting this recording onto YouTube in the next couple of days, and I'll send everybody a link to that. And also this deck, I'll also put it onto the CICM pages as well, CICMQ pages as well, into articles if I can, so that we can get access to everybody on this call. So I'm just stopping the recording now, and thanks very much, everybody, for joining the call.